Hi, everyone. Welcome to the latest issue of RE7's webinar. Today we have Sid from Maple joining us. Hey, Sid.
Hey, Evgeny. Glad to be here.
Good to have you. So, Sid, tell us, what do you do in crypto? How did you get into the space?
Good place to start. So I am the co-founder and CEO of Maple Finance. So you can think of Maple like a capital marketplace that's built on chain. So it's really there to facilitate alternative credit and allow credit professionals or credit underwriters to run a lending business, but they do so on chain. So they pool capital, they it goes into a smart contract, so it's non-custodially held, and then from that they decide which borrowers they want to originate loans to. They negotiate commercial rates with them, and then they collect repayments. And so you've got effectively two sides of this borrowing marketplace. You've got institutional borrowers who are typically market makers. They might be crypto miners in future fintechs and other different industry sectors that we want to get into. And then on the lending side, so people who are supplying capital to the platform, it's typically family offices, hedge funds, asset managers, and ultra high net worth clients. But the whole thing is built on top of DeFi rails. So this is one of the things we highlight. And the important thing to note there is that all of the loans appear on chain and all of the funds are held non-custodially. So that's one of the key innovations, which we can get into later, where I think DeFi really adds something meaningful to the existing tech stack of the financial system.
So, as you know, at RE7, we're obviously huge fans of Maple, as you can witness here.
Yes.
But I remember the first time I was learning about what you guys are building, it took me a while to figure out how to think about the risk, right? So someone goes into DeFi, puts money into a smart contract effectively, right? And then that money goes somewhere else. So clearly you can manage the custodial risk and everything around that, but how do you assess if these people are safe to lend to?
It's a good question, and so this is one of the core areas where, when we got started, the only type of lending that really existed in the digital asset space was of an over collateralized variety. So the very first businesses in crypto who started doing lending did so on an over collateralized basis, and these were CeFi lenders and businesses that you could almost describe as prime brokers. So the likes of Genesis, BlockFi, Celsius. So they started a number of years ago, and over collateralized lending made sense because you had very liquid collateral that you could custody for a borrower, make a loan, and then if they were in danger, if their position was in danger, the collateral could be liquidated. And so this meant that there was a minimal lift in terms of doing due diligence on the credit risk of that counterparty. Then as we saw lending start to shift over to the DeFi, the DeFi infrastructure, which is being built on top of smart contracts instead of requiring manual interventions, which is what characterizes or differentiates CeFi, we started to see that replicated the approach of beginning with over collateralization. Over time, the CeFi lending book largely moved to an uncollateralized format. And similarly, DeFi replicated that with one, Maple launching. Two, you have TrueFi, you have Goldfinch, you now have Clearpool, you have several players who are, providing under collateralized lending to institutions. But this, of course, necessitates having credit risk assessment. And so the way that this is done at Maple is actually in a fairly traditional format. So a borrower will go through KYC. They will submit to an interview with a delegate. So on Maple, the credit underwriting is outsourced to a delegate who's effectively running a lending business on top of the blockchain. And so they'll meet borrowers management, discuss how they use the proceeds of the loan, nature of their business, how they manage op risk, compliance, and then they start to get into juicier detail where they'll look at borrowers submit either most recent audited financials or monthly management accounts. And so that will give the delegate a view into the borrower's financial health. So how much, how levered are they? How profitable are they? How liquid is their book? And those characteristics will start to determine whether it's okay to lend to a borrower uncollateralized. So you're always looking to make sure do they have enough equity cushion? And this is particularly relevant where you have things like a hack. So Wintermute got hacked a few weeks back, but they had pretty good equity cushion, which they commented on publicly, and that just de-risked the concept of lending to them uncollateralized. And then you might also have borrowers who are extremely profitable, where they have a very high operating income margin, so they can meet your interest costs many times over and generate enough returns to fully repay the loan through profitability. So those are some of the ways in which you'd assess the credit risk of a borrower. And then you have another product, which is called Credora, which gives you a look at a borrower's ongoing balance sheet and how they manage their centralized exchange positions. So that type of product would have been particularly important going through the June-July cycle, where if some of 3AC's lenders had that in place with 3AC, they would have seen that they were net long, heavily long on exchange venues, and doing so with leverage, and they would have been able to see the liquidation point in those portfolios. So I think that's a tremendously useful product for monitoring ongoing loan positions. And so that really makes up the stack. So you have fairly manual due diligence, review of financials, and then ongoing monitoring provided by products like Credora.
Well, that's there's lots to unpack there. So
Yeah.
it's interesting you mentioned, the May, June, July cycle, right? Because the best test of a credit risk mechanism is a market collapse. So we've been blessed with a 90% market crash, right? Several multi-billion, multi-tens of billions dollar bankruptcies happening all over CeFi and DeFi. And it is interesting to hear from you how Maple has performed, because on our side, as you know, we mainly do DeFi. We are exposed to some of that, but in a very minor way, because mainly we take smart contract risk rather than lend, obviously, to these counterparties or take exposure. But it's interesting for us to see, the panic all around us, because everyone was expecting for everything to go to zero and to collapse and everyone to go bankrupt. So can you tell us how Maple weathered that storm and how it all played out for you guys?
Yeah, Maple's loan book performed very well. So we had, going into the crash, there were about 900 million in loans outstanding. And over the course of that cycle, there was only a single $10 million default, which was to a company called Babel Finance. And so that, on outstanding loans, default rate of about 1 and a bit percent. On cumulative loans originated, which was about 1.8 billion at that point in time, it was like 67 basis points. So loan book performance was very good, which is interesting because Maple was at the same time one of the most exposed platforms, in that it was the loan book was heavily uncollateralized. And so it speaks to the strength of underwriting done by the delegates and risk management in terms of not having a portfolio too concentrated to one or two borrowers, which was, of course, the case with Voyager, where they had, more than half of their portfolio was to a single counterparty. So it points to the strength of the underwriting that was done. And this was a necessity because Maple was doing under collateralized loans. There had to be very strong underwriting in place, or else the portfolio wouldn't have performed the way it did. And so I think the lessons to be taken out of this are, there are advantages to running a loan book on top of a DeFi platform, which some of the centralized lenders should take note of for future. So the visibility of the borrowers means that you never have a situation, if you're depositing into a pool, where you actually have one borrower who's half the pool who you didn't know about, and one day you wake up and read that they defaulted. So on Maple pools, all the borrowers are visible and you can see their performance in real time. And then the second element is that when you are depositing into a pool run by a delegate, that delegate is not custodying your funds. So you could have had a CeFi lender who was running a pool on Maple who might have collapsed because of difficulty or stress elsewhere in their business, but that pool would have continued paying back to depositors, and depositors would have been able to claim their funds back without being commingled in some kind of bankruptcy proceeding. And that's because it is a smart contract that is holding people's funds. So they can't be frozen and have withdrawals prevented, nor are they exposed to activities that might have been done elsewhere in the CeFi business, like yield farming, arbitrage trading, and other, other activities that are more closely resemble a hedge fund than a lending company.
That's that's pretty interesting, because thinking through this, if you leave crypto aside and imagine that you're running a prime brokerage business in the traditional world, hedge funds.
Yeah.
My bet would be, if someone comes and says, hey, I'm running a credit facility, which are uncollateralized, and I'm lending to these hedge funds, and the market is down 90%, I would expect for there to be much more serious losses than just 1% or 67 basis points.
Yeah.
So is it fair to say that the tooling that exists due to blockchain, which is a combination of smart contracts and real-time visibility, are they superior to what the traditional finance industry uses as well?
Yes, 100. I'll take the affirmative argument there, and I think the observation to make is that traditional finance is largely a matter of balance sheets. So if you look at it, the technology is actually, except unless you're a high frequency trader or automated market maker in traditional finance, the technology stack is actually not that great. And so really what you're doing is you're actually reliant on balance sheet. And so when you deal with a custodian, when you deal with another counterparty or a clearinghouse, you're actually looking at what is their credit rating, because you're taking the bet that their equity can absorb any mistakes or errors that they make, or operational risks. Whereas when you look at DeFi, or rather crypto and the use of blockchain to construct or provide these functions. So in Maple's case, it's providing the infrastructure to run a lending business. We don't need to have a thick business. We don't need to have a thick balance sheet, because people are reliant on technology to just facilitate loans. And so when you look at the lending structure that is operating on top of Maple, most interest is passed back through to depositors. And that is because they're not renting the balance sheet of the delegate. So in conventional lending businesses, you lend to a bank or a CeFi lender. In the case of crypto and digital assets, you lend to them at 5%, they lend it out at 10%, and they keep a 5% spread. And what you're paying them for is the liquidity. So they have an equity buffer, which can meet your redemptions and withdrawals, and which can absorb any defaults. But in order for them to rent you their equity, they are charging you a pretty high rate of interest. So they're charging you about half of what the loans, half of the interest in their loan portfolio. Whereas in Maple, you're putting your money into a non-custodial smart contract. And so you're paying for the underwriting service. You're not getting much in the way of balance sheet benefit from the delegate. But the trade-off there is that they can't prevent you withdrawing funds, and you get to collect most of the interest that comes through from those loans. So a Maple loan book might be earning, let's say, 10 or 11% on average, 90% or 85% of that interest, but a very high proportion is getting passed back through to the lenders. And then the delegate will take a 10% cut for having serviced the loans and done the original underwrite on that. But they're not putting up their balance sheet. And so in that case, you're not lending to the delegate at 6% and then lending out at 10%, which is the case in CeFi. And so what I see happening is that the fact that you can now rely on technology, so you can see when you put money into a lending platform on DeFi, you can see who the borrowers on the other side are. You can see how the funds are being deployed. You can see the reserves. You can see the interest yield that it's paying. And you can rely on the money going to the right place each time. So there's also less operational risk. I think that as a whole means that DeFi allows for nimbler and lighter balance sheets, whereas because TradFi relies on counterparty risk and balance sheets, it leads to an aggregation and market concentration, which is actually very unhealthy for an ecosystem. You don't want an ecosystem that coalesces around a few very large players you can't let fail over time. I think that actually, it leads to less volatility in the market, but over time, it actually leads to more existential risk of failure if one of those big players goes under.
Well, that's why we've seen too big to fail. And every time those risks are, being addressed, it's actually becoming even bigger, right? So it's all about passing on those liabilities from corporate to governmental, balance sheet.
100%. The losses get socialized, while the gains remain privatized, which I think is a huge problem. It's not a healthy capitalist system.
No.
But what we've seen in CeFi is, if you look, we saw about a third of the market exit over the last few months, and so we've seen increasing concentration. and you're seeing increasing returns on having a larger balance sheet. And you're seeing things like exchanges, which actually withstood, among the CeFi side, exchanges withstood the crash the best. They are now aggregating market concentration, and they are offering new services. I'm pretty sure that every exchange is now beginning to roll out their own lending products. And so you're going to see them offering, multiple services, and that will lead to market concentration. And then when one of those goes under, it'll be catastrophic for the space.
Well, that's a delightful prophecy. So thanks for that. Something to look forward to.
But it's why I think that actually, like, a successful path forward in the market should be that these services get unbundled and done by specialists who use more smart contract rails for this. Like, you should just have institutional lending should just be done on a platform like Maple, instead of having it bundled with an exchange that also does trading, that also does other aspects of wealth management.
Yeah, I agree. That's what we're seeing in fintech, right? Down bundling, right? You take a bank that does a million things and you break it into a million different startups, and that's how you really solve for that.
Yeah. It's Coase's theory of the firm in reverse.
Exactly. So speaking about the ecosystem right now, how are you finding it? Are there opportunities for your customers or your borrowers to deploy capital at scale? Is there even desire to borrow in this market, which is, from the outside, those who are not in the space, they think it's, very, very dangerous. Those who are inside potentially think it's a little bit kind of zombie land right now where not much is happening. So you have these opposite kind of spectrums. But are these market makers healthy right now? Are they finding opportunities to deploy capital? Like, what's going on? What are you seeing?
Yeah, for sure. So there are still opportunities to deploy capital within the space. So market makers will still take down loans, and their balance sheets still remain relatively healthy. What they're not seeing is they're not able to deploy that capital at as high a rate of return as what they could before. So if you're lending to a market maker, they're not deploying it as profitably as they were 12 months ago, when you had a heavy amount of retail flow trading on the centralized exchanges, and you had, a steep futures curve there. So when the futures curve is steep, those guys can deploy it at a higher rate of interest. And when there's also more volatility, different kinds of market makers or high frequency traders can deploy funds that they borrow more profitably. And so you see a healthier borrow market. Here, the borrow market has contracted a bit, and that's why strategically we start to look at other places to deploy capital. But offsetting that, you've had a lot of supply of funds exit the market. As I mentioned, a number of the CeFi lenders have now exited, and that means that similar size or slightly smaller pie relative to what there was before in terms of how many borrowers you could deploy to is now just being spread over a smaller number of lenders, like Maple. And so that means that we can still deploy capital to these borrowers, and we still consider them, healthy, albeit they're not making the crazy rates of return that they were 12 months ago. What that means for us, though, is we think that that's still an attractive place to park capital at the moment, and you can still deploy it short term, so relatively short dated, at like high single to very low double digit rates. So you might be looking at net of fees, about 8 to 10% APY. But again, it's relatively short dated. So Maple's pools are now at a 30-day lock, which means you can put it in and retract your capital quickly, or you have the flexibility if there are other places to deploy it. So that's the short dated product we have. But we're seeing other people who, now that yields are going up, are looking for higher yielding opportunities. And so you have longer dated loans. So if you can do longer dated loans, there's a steeper yield curve there where you can put capital to work at like a mid-teens rate of return. So minor finance, which is a sector that had been under a bit of stress lately, is consolidating. And if you deploy capital there, you will be paid to participate because there is very little liquidity going there at the moment. So you can get heavily secured positions with full recourse over all assets on a miner's balance sheet, not just the ASICs, power equipment, any property, plant, and equipment that they have, as well as a custodied account, which sweeps all of the mined Bitcoin. So it's a fairly secure position. And across a portfolio, that'll pay about 18 to 20%, but that's a 12-month lockup. Yeah. And so we're seeing short dated products, 8 to 10% net of fees, longer dated products, 14, 15 net of fees. So those are the two places that people are looking to deploy for yield at the moment. But what we've seen overall is that in a sideways trading market, relatively few people are looking to go market beta. So all of the opportunities now are either in private asset allocation, so private credit, venture. There's very little in the way of private equity, but they're going away from just trading the larger cap tokens and getting broader market exposure to now instead looking for private opportunities. So if you put money into a private credit pool, for example, like Maple, you're not taking the mark-to-market losses that you are on like a fixed income portfolio, where as treasury yields go up, the mark-to-market, unless you're in very short dated T-bills, is you're incurring a loss on that portfolio.
Yeah, I'm seeing basically exactly the same. What you're describing in DeFi, right? So a bunch of capital has left the space, which on one hand creates new opportunities. On the other hand, the volume is lower, the volatility is lower, so it kind of offsets back to where it was.
It's that lower volatility, I think. Like if you're doing private credit, unless you incur a heavy amount of defaults on your portfolio, you're going to continue to generate yield whilst having capital preservation. Whereas if you go into like public fixed incomes, it underperforms. Yeah, because you're taking the capital loss on your shorter term mark to market. Yeah. So people want low volatility yield at the moment.
Yeah, absolutely. I hear the same questions. Why would we go into a DeFi or CeFi, yield product where we can get, a few percentage points on treasuries? Then you tell people, well, then, your treasuries are down 20%, long dated ones year to date, whilst CeFi lending or DeFi yield actually keeps making money. So yeah, you have a lot of these biases, which I guess happens when tourist capital leave the space. But on the DeFi side, I think we're seeing something very, very similar.
Yeah.
So you touched on something interesting that you're seeing opportunities beyond market making, and you mentioned mining as one of the spaces you're looking at. Can you give us an insight into the future of Maple? So how do you see this business a few years down the line? What types of assets, sectors, and geographies could you guys cover? Would this be only crypto related or broader? Like how are you thinking about that?
My vision is for it to be broader. So when me and Joe, my co-founder, created Maple, the vision was that it should be a capital market that is applicable to any corporates who are growing, who are doing innovative things, and it should be global and worldwide. Like a capital market is a way in which innovative companies can grow, innovation is funded, new jobs are created, and it really facilitates this idea of creative destruction in the private sector. And so I was always really influenced by the idea that it was the joint stock company, which was this innovation hundreds of years ago that really facilitated the age of discovery. So that was pairing capital with entrepreneurs and explorers. I think the current market at the moment has shifted probably too far in favor of equity, as opposed to debt to unrated corporate borrowers. And so our vision is that private credit should, across all sectors and all geographies, shift on chain for facilitation. Because when you see it costs, like when you look at the private credit or private lending sector, it costs a lot to set up those funds and those businesses. And that means those costs ultimately get passed on to the borrowers. And it's a heavy toll on the overall flow of capital around capital markets on the debt side. What we always treated and viewed that market makers were the initial wedge, and then we'll go to other adjacent crypto native companies, so minor finance, but then we'll start looking outside of crypto. So we would serve fintechs and then broadly start going into other sectors of the economy, whether it's consumer electronics or other types of sectors. But what we need to facilitate that is we need things like easy on-ramps. But my view is that the use of smart contracts and blockchain infrastructure to run lending businesses is not going to be viewed as, DeFi will eventually just be finance. Like it's going to move and be just the default way in which financial businesses are operated. Because if you look at lending in particular, it just allows you to run a lower cost to income ratio business. And so it means that you will outcompete other lenders who are doing this in a Web 2 kind of format, where you have to go and set up an SPV. Every loan costs hundreds of thousands of dollars in legal fees to negotiate. If you can standardize it and make it repeatable, you outcompete those businesses over time. And so as new lending businesses are established, they will naturally operate on the lowest cost set of infrastructure. So that was kind of a long-winded answer, but again, just to reiterate, my view is that all industries will eventually move here. It'll begin first with the most tech-forward ones, because they'll be able to use and operate things like connecting a wallet, using USDC, and off-ramping it, or Tether and off-ramping it into fiat dollars. And then it will be global, because there's no marginal cost in serving a borrower or a lender in Japan or in Hong Kong or in Singapore versus in the UK or in the US. So I think it's, similar to Netflix, where it had zero marginal cost of distribution. That's like a really powerful driver of aggregation that leads towards economies of scale when you do this, when you run this as like a platform.
Yeah, this makes obviously total sense. I guess one final question from my side, which I'm curious to see how you think about it. So Maple is one of the first platforms to offer permissioned pools, KYC pools. So we have DeFi where anyone with a wallet can do whatever they want without any checks and balances. But obviously that's not necessarily fit for multi-billion-dollar institutions who need to do things at scale and in a compliant manner. How do you think it will work in the future? Will you have the degen DeFi and the KYC and permission one, and will there be a bridge between them?
I think both will exist in parallel. So if you look at it, our view is that you need to have effectively free association on DeFi, and this meant if we'd only had permissionless pools, then over time we wouldn't be able to accommodate large institutions who want to benefit from this infrastructure. And so we wanted to offer them an option that they could use, so that you can have the large institutions on there, as well as smaller institutions or institutions that have a different focus who are happy using the open pools. I will say the open pools still use tools like TRM to block sanctioned addresses. So we're still trying to take a prudent approach there, but those were more scalable. Whereas as we've now grown and want to tap an institutional market, we need to offer both, because there are institutions who, because of their own internal mandates, can only use pools that are fully permissioned. And so our view was always that we should be able to serve, the breadth of the market there. And so I think because it's actually not, if it was, think about it this way, if it cost a lot to run, produce or run an institutional pool, then I think you'd see protocols gravitate towards one or the other. But there's actually almost zero marginal cost in now setting up a permissioned pool, and that is at the behest of the delegates. The delegates operate it, they can turn on permissioning, and then that lets them cater and sell to a more institutional crowd who might be regulated or just who have different compliance mandates. But because there's no cost to operating both, I think they'll both continue and grow in parallel. I do suspect that over the near term, probably more growth will occur on the permission side.
Interesting. So that's some alpha for all of us on the DeFi side to go and get KYC'd.
Yeah. Well, you can, depending on which way you look at it, you could say that if you get into a KYC pool, then there should be a slightly higher fee because there's more limited supply. Another way to look at it is that you're almost perhaps paying for an additional service in the way of compliance. And so perhaps you should be willing to accept a lower fee to be in one of those pools.
Yeah. That's not what degens like to hear, but that's
no.
Yeah.
Well, in that case, the degens would be slightly better off because other institutions would be paying in the form of a slightly lower yield to get into a permissioned pool.
Yeah, absolutely. And finally, how do you see Maple fitting into investment portfolios of an institution, right? So you are a pension fund, you are a multi-strat hedge fund. Is there a place for Maple, or not necessarily Maple as a, Maple as Maple, but that risk return that you represent, do you feel it's fit?
Yeah, it's difficult for me to talk about risk and returns because I don't know, I don't know the individual kind of mandates of a lot of these places, but nor do I want to give them investment advice or anything like that. So the way I think about it though is that direct credit or private credit and direct lending, I think, have a natural place in large institutional asset allocations. Similar, they'll typically have private allocations like venture capital, maybe some private equity, and this would form part of an overall alternatives allocation. So I think Maple most naturally fits into the alternatives basket, and then within that, it's a form of alternative credit. If you look at what it has going in favor of it, I mean, as an allocation, it's going to be lower volatility. There's some capital preservation. It offsets, the general market beta. But then if you look at the favorable aspects of Maple in particular, it is the transparency. So if you're going to a CFI lender and they're offering you 10%, well, let me tell you, do you know whether they're paying that out of their own equity because they just did a fundraise? Is it because they're doing some DeFi stuff and other sort of riskier strategies? Or are they running their own arbitrage trading strategies? Or is it coming from their own lending? And if they're saying they're getting it from lending, is it over collateralized lending or under collateralized lending? Because I guarantee you they're not going to show you their portfolio distribution, nor typically when you give one of those CFI lenders funds, do they show you their financials? But effectively what you've given them is an uncollateralized loan if you think about it. And so I think the advantage of Maple in particular over going with a CFI lender just by themselves is the transparency. So you always see where your money is going, and you can always see the overall asset balance. You can see that the loans aren't impaired, that they're performing, how much cash is in the pool, and that you can get it back because it's not custodially being held by that player. So I think that's where it fits in. So if I was so again, just recapping, kind of falls within the alternative credit section of an allocation, and then what it's offering you versus other opportunities is transparency in that non-custodial aspect where that you don't have to rely as much on counterparty risk, which is coming back to the overall theme of DeFi versus TradFi, is that it's balance sheets versus technology. And if the more you can rely on technology, the less you have to rely on counterparty risk and balance sheets.
And we've seen how that performed over the last few months, with the reliance on untransparent counterparties unfortunately led to some huge losses, whilst transparent technology, Maple and DeFi more broadly, did pretty well, to put it mildly. So clearly data is supporting what you're saying there. As we wrap up, what would be one final thought you would leave our listeners with? What should they expect from Maple, from DeFi for the next year or so?
I think you'll see broader expansion of DeFi. So, we already are in the process of adding other borrower verticals. So we just recently added minor finance as a pool opportunity. We're looking to add other industry verticals like fintechs, for example. So I think you'll expect to see a broadening of the lending products offered in DeFi. And I think also what I would hope to see is more kind of partnerships where you have CFI lenders or other large, CFI players using DeFi infrastructure for those reasons I mentioned. And I think that'll be insisted upon by their customers who want to see more transparency. And so once you see the first CFI players start to offer a DeFi focused credit strategy, because it's being done on infrastructure, whether it's Maple or one of the other players like a Clearpool or a Goldfinch, I think once those partnerships start to take off, most CFI lenders will start to shift their business operations over to using DeFi infrastructure.
That's the bet we're making as well. DeFi will clearly finance, and there's lots to be excited about. So thank you. These are busy days for all of us, so thank you for making the time. Thank you for sharing the alpha and showing us the future. And should the market crash another 90%, I'm looking forward
Let's see.
pitching up and seeing how lending performs then, but hopefully we should be okay.
Yeah, awesome. Thanks, Evgeny. I really appreciate it. I had a great time.
Thanks, Sid, and thank you everyone for listening.
Thank you.
Yes.